The New Jersey Bank Marketing Association presents the May 2010 Bank Marketing Seminar held at the Crowne Plaza Hotel in Clark, New Jersey. I'm your host, Steve Lubetkin. In this program, a presentation by Larry Cohen, Vice President and Director of Strategic Business Insights, a consulting firm located near Princeton, New Jersey.
Thank you, and I appreciate the fact you didn't mention that I'm actually Jon Stewart's evil older brother. This is a rumor that somebody started for no reason I understand, and, well, my son found this song, a singer-songwriter came up with. A couple of lines go like this, from New Jersey. If the world ended, I would adjust. I think this morning is a perfect example. We managed to have a full room here in spite of the fact, well, the Garden State Parkway is backed up from wherever to whomever. New Jersey's different. We all live here. We know it. You know, people think about us as, you know, that place between New York and Philadelphia where all the oil refineries are. I don't know about you, but what exit, you know, everybody asks, what exit do you live at? You heard the new state motto, of course. New Jersey, take someone with you when you leave. And I believe we have more ex-mayors in prison than any other state. I mean, we have a lot of things that make us unique, though. For example, some people, and we trade this back and forth with Connecticut, that we're the wealthiest state in the country in terms of income per capita. Connecticut sometimes, us sometimes, but not New York, not Chicago, New Jersey, right? We're also the most diverse state. Variety and numbers of people who are not mainstream white Anglo-Saxon Americans. We are, if you will, the beginning, the shore of the change that the entire... So communities firsthand begin to experience this, and you, who are financial services providers, are actually on the front line of providing the services that people need in order to live their lives. So you're at the forefront. I mean, it's an experiment, and we are the experimentees and experimentors. What I'm going to try to talk to you a little bit about today is how the financial services world is changing. I'm conscious of the shortage of time, so I may skip through a few things. I will try to give you the basis of what I think is the new normal. Not Bill Gross's concept from PIMCO, but more what we're going to deal with in terms of consumers and their financial needs and how they get those needs met and how that's changing right now, because it is changing. Dennis mentioned the macro monitor. I've been fortunate enough, or cursed, depending on how you look at it, of having a survey that has been done on a biannual basis since 1978 that just focuses on financial products, services, financial attitudes, and things of that nature. It's a trendable study that goes back 32 years. And if you think of the last 32 years, there's been a lot of stuff changing in financial services. So I've been able to watch that and track that and look at underlying demographics and how they shift and look at how the attitudes have shifted and things like that. It's been remarkable because it's not just banking, it also includes insurance, it includes cards, it includes investing, retirement, pensions, healthcare, anything related to financial services. Because basically, consumers don't look at financial services a lot like we do. Whoops, upside down. Okay, I'm going to try to do this again. Many view consumers basically by age or income or their assets, or maybe by the products they own or the channels they use, or one of their objectives like buying a house or buying a car, saving for retirement. Typically, in our business, we tend to look at them through this one unchanging dimension at a time. But the reality, as we all know from our own lives, is much more complex. It's a dynamic and organic type of a thing, where all of these different needs interrelate at the same time. Households basically have a holistic view of their entire financial situation. They're not looking at it just like, oh, I need a CD. They're looking at it, oh, I need a safe place in order to save my money for a certain amount of time, because later on I'm going to use that money to do X, fill in the blank. It's a unified whole, but it's in constant change. There are incomes and there are outflows. There are multiple people they're taking into account. There are short-term goals and long-term goals. There are limited resources, for most of us anyway, with competing priorities. Okay? An impact in one area causes a reaction, sometimes in a totally different area. Households react, adapt, adjust. They reallocate their resources. They change their priorities based on what's going on. And how financial providers may notice one change in one dimension, but have little idea of the influences on that beyond that one little change. And what we're trying to do with our survey and our services is to give you that more holistic view of what's going on. We now live in a world of full convergence. You know, basically you can get any of your products from any of your competitors, even from other types of institutions. You can get them on the internet. I saw a hot dog vendor once selling mutual funds in Lower Manhattan. You know, you can, it's, differentiation based on product is pretty much gone. When products become commodities, there's really only one way a provider can differentiate themselves from their competitors, and that has to do by brand or image or the customer service. And in this environment, gaining the relationship, maintaining it, expanding it, and retaining it, it's the only way to gain market share. Now, that's both the bad news and the good news, because it's harder to get these types of relationships than just sell products. On the other hand, they're stickier. When you have them, they're not likely to just walk out the door for 25 basis points. And the best way to accomplish this is with this complete holistic understanding of households' needs, and as many of those needs as possible. Now, in the last 18 months, as Joseph Heller said in his book, something happened. A lot of change has occurred. But actually, it topped off an entire decade in which the consumer has experienced all sorts of impacts that have changed the financial services landscape. All areas of financial needs have been affected by this. And even though consumers do tend to change slowly, they don't react quickly to the things going on, it's inexorable. They do eventually change. And by examining the shifts of these interconnected trends of product demographic ownerships and goals and preferences and attitudes, and looking at it over the last 2 or 3 decades, but most importantly the last decade, we can get some very important insights into how they have changed, where they're going, and what it's going to be like in this new normal. The key here is to understand that complexity and uncertainty that you're dealing with pervades the image for the consumers too. They don't know what's going to happen in the future any more than you do. So remember this, their needs are constant. Their priorities may shift in reaction to the events. So, basic premise, they approach the situation holistically, and products have become something of commodities. You're getting that ready for me, right? Oh, excuse me. That's in case I start to wander. Yeah. The last 18 months have forced a lot of changes. And through the interconnected trends of all the demographics and things, we're going to try to get some insight, and I'm going to give you some insight today in terms of how they are changing. This is the new normal. Welcome. First, some long-term trends. This is a trend in terms of households' mean amount owned and owed over the last 20-some years, back to 1982. You can see the amount that they owe in total debts has gone nowhere but up over the course of the last 20-some years. Investable assets have also basically gone in a straight up, but notice in 2008, which was the last time we did a full field, it was basically static. Financial assets show the same basic pattern, not much increase between 06 and 08, but over the last 2 or so decades, they've continued to go up. The equity in the home, this is the thing that's really dramatic. If you look over here, and I can do this, 06 and 08, huge increases in terms of the equity in the home, right? And of course, that then has this impact on total assets and net worth. Okay? So back to our theme, something happened, right? Well, we did something we've rarely done. We went back and interviewed the people we talked to in 2008, again in 2009, and said, did anything change for you? And then we took their answers and we adjusted some of our questions from before, like, how did this have an impact on how much you owe and how much you have? Well, one thing, you know, assets can go up and down, but debt is forever. And so the amount that people owed really did not change very much. However, the amount that they had in investable assets has gone down significantly. In spite of the fact that the market has come back now, not as many people are in it as were in it before, and those that are in it are not in the same types of investments, so values are down. Equity values also are down, and probably continuing to go down. So for the first time since we've started measuring these variables, we may see the next time we go out to field, which by the way is now, we're going to be in field for the next 10 weeks, collecting the same type of information for our 2010 wave. Net worth has declined. Total assets has declined. The biggest part of every household's balance sheet, both on the asset side and the debt side, the value of the house and the amount of debt on the house, while the asset has gone down, the debt pretty much stayed the same. And this is part of the background environment to which people are reacting emotionally and making their decisions in terms of what they're going to do with their limited resources. We've been looking at consumers using a lens of life stages since 1992 because age was losing its ability to predict when people did things. I mean, after all, people can have children when they're in their late teens all the way up to their late 40s or 50s if you're Michael Douglas and a few others. So we created a new segmentation in 92 to try to look at consumers and understand how their needs shifted based on their life stages. And this was the map. We looked at households first if there were children, and then on the age of the oldest child, whether they were under 12, whether they were teenagers, or whether they were over 18, or as we like to say, the good, the bad, and the ugly. And then we took those households that didn't have children, and if they were retired, we put them into two groups based on whether or not they were past 70 and a half, because you have to start taking your money out of your accounts. And that's a major financial shift. And then all the people that were left, we divided them up into the ones who still could have children and the ones who probably would not have children. This was 1992, and we assumed at the age 45, if you hadn't had children by then, you probably wouldn't. Like I said, things change. This is the trend over the last 2 decades or so, and something happened around 2000, where the peak of this household formation life stages dropped off. Fewer new households were being formed in which there was a single head of household without children or two heads of household living together without children. And this dropped off, as you can see, significantly after 2000, okay, and has continued at these lower levels till now. Now, it's not like there aren't people that age. It means they stopped going out and starting their own independent financial units. And if you think about it, and I've looked at the census numbers, the number of people in that group has actually continued to go up. Grow up and go up. So in effect, there's increased demand for them to go out and form their own households. In spite of what we know a lot of them are doing, boomerang kids, you know, the ones who leave and then come back, and then you can't get them to leave. It's like Italy. I hear 40-year-old men still living with their mother. Very strange. Since about 2002, we did see an uptick that once those children living at home that aren't children have children of their own, they do tend to then get kicked out of the house or move out because nobody wants a crying baby when you want a grandchild. Big difference. And that's something that's new and probably will continue. So, you know, if you have kids living at home, the quickest way to get rid of them, have babies. We also saw this other trend of households in which kids over the age of 18 were still in the household. And these were not the boomerang kids, because these are ones that you can declare on your taxes. We asked other questions that turned out to identify those who have children who you can't call your own on your taxes but are still living in your house, sleeping on the couch, raiding the refrigerator, and throwing their laundry on the floor. And there are over 11 million households out of the 125 million in the U.S. today that have one of these boomerang kids in the house. And I think that number over the last 2 years probably didn't go down and probably went up. And that's a phenomena of, again, going to a multi-generational type of a household situation. This isn't the parents, it's the kids coming back. The other thing that the last 2 decades is very well known for is that basically, oops, come back here. The number of pre-retired households, okay, kids out of the house but not retired, has doubled. This is when the boomers, that pig in the python, have moved into the period in which they're pre-retired, sprinting for retired. The kids have finally left, I hope. Boomerangs are included in there. I haven't pulled them out, but the idea is that people of that age, that's where the pig is now in the python. And this is important because this is a big shift in terms of financial needs. Younger retirees and older retirees, there's been an uptick in the younger retirees. And although there was an increase in older retirees, it does now seem to be plateauing. Okay? This is the trend of the types of life stages that you're selling to, because these are the people in your community. And this is where we're starting to look now when it comes to looking at financial needs relating to different life stages. For example, we've included this boomerang kid, which are primarily in these life stages, to represent households in which the adult children are back in the household. Because if you're trying to save money for your retirement and you have somebody who's still eating food in the refrigerator and running the laundry and using the car and everything, it's really hard to save as much as you could if they weren't there. And then we also realize that some of those kids may actually be outside of the household, but the household is still paying for part of their rent or making some type of regular contribution. So between the boomerangs and the extended adolescents that are out of the house, a large portion of households, particularly those that are in this pre-retired life stage, have expenditures or costs that are not going towards their own retirement, but in fact going to try to establish independent households. And that's one of their major concerns. At the same time, you have a lot more of these types of boomerangs. Parents who are now moving back into the household. So you have, the traditional, we're in the middle of the sandwich generation, where people have parents that they're taking care of either in their household or outside of their household, as well as adult children that are in their household, and some of them are, have both in the same household. And I've often thought if those children also had children and were still in the household, then you'd have what is a triple-decker sandwich. Okay, also known as a club sandwich. In thinking about retirement, one of the things that's occurred is we've extended the period that we consider retirement to be. Retirement used to be a line in the sand. Up to the point where you got to retirement, you just, earned your money, raised your family, did whatever. You crossed that line in the sand, and from that point on, you lived off of the money you had accumulated, or your pension, Social Security, or things like that. That was Father Knows Best, Ozzie and Harriet, 1950 types of retirement. That's not retirement anymore. And if the events of the last 2 years are an indication, we're going to see that line in the sand turn into its own life stage in which people cycle in and out of retirement, something we call revolving retirement. And we're starting to measure that too, and we're finding that that's growing at one of those product introduction rates. Started off slow and picking up speed. The economy in the last 2 years has done nothing but accelerate that, as people who were thinking, I'm a few years from retirement, looked at their IRAs and 401ks and said, not so fast. And people who are thinking, I can't wait to leave this job, are now thinking, I hope I can stay at this job just a little while longer. It's funny how plans work out. Not funny, ha-ha. So we have this revolving retirement period that we've added to the between pre-retirement and traditional retirement. And if you think about it, at age 65, if you and a significant other are both basically healthy, one of you is going to make it to 90. It's a pretty high probability, which is 25 years hence. So retirement, which was originally conceived in 1933 as being, 6 or 7 years that will pay you some money so that there will be a job for a young person during the Depression, now is 25 years or 30 years of what? You can't just live off of it. We all know what's happening with pensions. Even the state of New Jersey knows what's happening with pensions. We can't afford it. and it's going to have to change. So we're going to see revolving retirement become the lifestyle of choice for those people who are in that age group, life stage. But then at the other end, you've got the post-retirement here. And I'm not talking about the little room or the urn. I'm talking about the period during which, after an early retirement or revolving retirement, you may be focused on living off of the fixed assets that you have, or on your health issues, or on dispersing your assets, or things like that. So the reason why this is important is the products and services that you offer go to enable people to do the things in these life stages. And as the life stages become more complex and and varied, the products and services, the way you market them, the way people use them has to adjust to fit the needs that they have. And this is to provide you with an idea of what their focus is and what those needs may be related to, so that when you offer them, when you put ads there, when you talk to them about it in your media and otherwise, you can make it relevant to what they're going through. During the 90s, we fell in love with financial services, and we just kept adding institutions, products, and services without even thinking about the implication of this, because, oh, there's a new mutual fund I'd love to have. Gee, I'd love to have one of those debit cards. Oh, online banking, how cool is that? And then we reached the point where we realized we're spending all of our time doing financial services and we forgot to live our lives. What happened is we actually saw a plateauing and maximizing in terms of the use of our time. And since about the year 2000, it's actually started to decline. It's being put back into perspective, if you will, back into balance, and the priorities are being balanced in people's lives. And they're trying to spend less time and less effort on their financial services. So we're seeing that this mean number is actually starting to decline, and will probably continue to decline. This has to do with the coming consolidation that people are going through in terms of both their products, services, and financial relationships. And this one has to do with the arc that the 90s was a bull market on all financial products and services. Has anybody come up with a name for the 2000s, that decade? No. I would like to propose we call it the uh-ohs, because that seems to be pretty much what happened when all of us were going through. Uh-oh, uh-oh. So in the uh-ohs, these things have started to decline, and what we're saying is this is going to continue to decline, which means that the relationships you have, you need to expand, because the competition isn't so much for more products and more relationships. It's between various providers of these, and for consumers to be able to do this, you have to simplify, make it easier for them to combine. Another reason why we're going to need consolidation is this one. Now, I know this looks complicated, but basically it's the same chart, but instead of looking at it on the basis of the years, I'm looking at it on the basis of the life stages at the bottom, and then net worth on the side. And if you look at this, you'll notice, I'll try to draw these lines, there's a peak in terms of the number of relationships that typically occurs regardless of the level of wealth, somewhere right around here. That's the life stage, whoa, sorry. That's the life stage at which peak number of relationships occurs in the household. It's also the life stage where the household basically shifts from transactions and debt to saving and investing. It's also the period in which you have the most overlap, and it's also the period in which the most boomers are now. So, from this point out, that pig and the python is going to be going through the second half of this chart, no matter what their wealth level is, and declining the number of relationships they have, declining in the number of products and services they have, and eliminating relationships and products and simplifying their lives. It's visceral. I mean, anybody who's a boomer will tell you that if you've watched your parents over the last 15, 10, 5 years, you've watched as they went from the big house you grew up in to that smaller house, finally to the retirement house, then to the retirement community, then to the assisted living community, then to the nursing center, and then to that small room without windows. And at every step along the way, they got rid of stuff. I mean, when you think about the boomers, you think about conspicuous consumption. You think about decades of how many BMWs, how big a house, how many children. Well, maybe not that, except Angelina Jolie. But, you know, accumulation and all sorts of conspicuous consumption. Guess what? Not anymore. We've turned the corner, and now it's conspicuous conservation. It's doing more with less. It's simplifying my financial services. It's getting rid of unnecessary, oh, I have this one mutual fund. I bought at Janus one time because I thought it was a good idea. I'll sell it. And simplifying their lives because they've watched what happens to their parents. You know, eBay and swap sales and garage sales, these things are really popular now because of the economy. But I propose to you it's not just the economy. I propose it's also a basic demographic pattern that's going to continue after the economy, well, I'm not going to say recovers, adjusts and changes yet again. So, second reason for conspicuous consumption. And the third reason is this sociological thing, you know, energy use. We're all trying to cut back on our utilities. We're trying to drive less. We're trying to use, you know, less resources. In New Jersey, we recycle just about anything. I love being from New Jersey. Everybody looks at you and kind of wonders, now, what exit are you from? So we're seeing three things that are all pointing towards this idea of consolidating, simplifying, and conspicuous consumption. And this will translate into your customers, your neighborhoods, one way or another. They want to make their lives easier, simpler. You know, one of the great ideas that did not get into the regulations for financial products that was being considered was the plain vanilla products. Remember that? Consumers would love that because then they don't have to worry about the complexities. I mean, I don't know many consumers that show up probably at the bank and say, can I get a CDO with a derivative swap, please? You know? But all I want's an auto loan, you know, fixed rate, regular amounts that I know when I'll pay it off. I have to go to work. I need a new car, you know. Plain vanilla actually is very attractive in a lot of ways. The most popular flavor of ice cream, you know. Anyway, households have lost wealth, not debt. We all know that. There's a whole lot of new life stages that are evolving for demographic reasons as well as economic reasons as well as lifestyle reasons. One of the things I'm watching, and I certainly hope it doesn't happen, but we may be heading back towards multi-generational households. Last time that was really, you know, prevalent was before the 30s. We could actually be heading back there. I mean, after all, if you have a McMansion, one way you can use it is to fill it with a lot of relatives. Doesn't that sound like fun? There is inevitably a consolidation going on in terms of financial relationships and products. Let's move on to real estate, okay? Biggest part of what a lot of people are worried about, the house over their head. And over the course of the last 2 decades, the incidence of home ownership just went straight up. I don't think it's going to end up, the next point on this is going to be up here. I suspect it's going to be more down there. Renting the home, actually it already started going up in the last couple of waves. And I'd be willing to bet, and if you talk to your communities, I bet that incidence is going up and continuing to go up. After all, where do you put the boomerang kids when you finally do say, I'll pay your rent if you move out? I'm not going to buy you a house. Other real estate, which we also measured, had been moving up. I don't know if that's going to go up or down because we look at it by a couple of different flavors. One of them has to do with people having second homes. That, I suspect, will go down. But the income-producing homes represents, for some people, Social Security, a way to retire with an income stream. And so some people may continue to be looking at income-producing property as a way to, especially if they have some assets that they want to invest. And again, this might be something where you could probably help out in terms of your households in your communities. Total debt. I love playing the game of what will the next measurement be? Do you think it'll be higher or lower? I think we all know which one that's going to be. Equity debt. You see, the thing that's important here is we tend to lose sight of it. It's just another form of debt. It's the biggest. It's the 9,000-pound gorilla in the room. And it's one of the reasons why people look at their homes and think, Well, it's an asset because I'm saving on it. It's going down in value. I'm being taxed on it ridiculously. It's also the biggest debt on the balance sheet. So if you think about the last 2 years, this number probably down to around there. And when people, you know, back in the 90s, when people thought they were wealthy, they behaved like they were wealthy. They'd shop, they'd buy things on a whim, they'd go on a vacation because, oh, I can just borrow some money for that. Now, they don't feel wealthy. Even if they have money, they don't think they're feeling that flush and affluent, and they will behave like they're not flush and affluent, even if they have money, which is what we've seen. I know we've all seen the retail sales have gone up in the last couple of measurements. Look at the level from which they're measuring that, because it has gone up from here to there. It hasn't gone up very much from where it was like before. And I think that's the important thing to think of when you're thinking about the role you're playing and the products you're offering. There's a new normal in terms of where the bar is set. Don't go make the mistake most investors do, that when my IRA was at $100,000, that's what it is worth now. It just happens to be a lower number. You know, don't think that I'll wait till it gets up there again. No. Eventually consumers will say, you know, I think of my IRA as being $100,000 even though it says 70. But when they try to spend it, it's still only going to be 70. So start to set expectations based on the current reality. Home ownership declining, equity is down, debt not so much, people feel and are poor. This is key. You know, we've gone full circle. Banking, plain vanilla banking, isn't about return, it's a safe place to put my money, where it'll be there when I go back, when I need it. You know, the best way to make a large fortune on, a small fortune on Wall Street is start with a large one. The best way, and people are beginning to orient to this again, is to save money to build up for something. And we're seeing delayed gratification start to creep back into the motivation. So instead of going out and buying a car and going into debt, they're trying to save money for 2 years and then buy the car with a larger down payment, maybe a smaller loan, a lower monthly payment that's affordable, especially if something happens to my job. And of course, we all feel that same sense that the jobs aren't coming back quite as quickly as we would hope. Borrowing. Another long-term trend. Notice something here. This is the incidence of households that have at least one credit card with $1 outstanding on an ongoing basis. It peaked in 2000. Vehicle loans peaked in 2000. First mortgage, no, it peaked in 2008. But I think we know where that number is now, probably lower. Other forms of credit, which you can see at the bottom, is pretty much all the other unsecured and secured lines of credit, installment loans, blah, blah, blah. Those have been going down since the mid-90s because lots of people have been putting that into home equity lines of credit or second mortgages, but much more home equity lines of credit. Even home equity lines of credit and second mortgages between 06 and 08 went down. And I would be willing to bet they've gone down again, 2010. Okay? So all of the incidences of credit products, except mortgages, went down in 06 to 08. I would be willing to bet they've gone down from 08 to 2010, including mortgages. Maybe it's a good thing overall, but it's the reality that you're facing. Now, I know a lot of consumers are talking about, oh, I can't get a loan, I can never qualify, I don't have an 890 FICO score. Maybe FICO scores aren't the only way to evaluate people, you know. Maybe combining it with some savings product as well as something that's a credit product shows that regular payments can be made and you can do things like that. There are banks out there, large banks out there, who are doing things like that because they're combining the needs. Households have all of these needs, and that's a way to develop the relationship and keep the loyalty. We did ask in our recontact study, what's the reason why you might borrow in the next 12 months? Now, this was from before the fall, and you can see buying a vehicle, buying a home. After the fall, these are the numbers, okay? And you can see some huge changes. And I'm going to rank them from the things that people are now least likely to do to the things they are most likely to do. So between before the fall and after the fall, buying a vehicle, other real estate, vacation travel, major appliances, all have gone down significantly. Things that have gone up: paying for education, home repairs, consolidating debt. Gosh, doesn't that sound pragmatic? I mean, isn't that basically when you suddenly say, okay, if I'm going to borrow, what do I have to borrow for? Well, the roof needs fixing. Yeah, that's pretty important. I'm not going to put that off. But vacation in Bahamas, not so much. Or Vegas. You know, if you've ever been there, you watch people who take their life savings and basically blow it in a couple of days. It's just amazing. Anyway, consolidating debt, more pragmatic uses. So if you're marketing to this type of an environment, focus on pragmatic, focus on realistic, focus on the things that make sense from the standpoint of somebody trying to get control over their financial situation and have long-term needs and are willing to perhaps delay that instant gratification a little bit. I would never get a personal or auto loan that had an interest rate that could change. All right? Notice, oh, there's my mouse. This sort of peaked here and has gone down since. It didn't just happen in 2008. It's been going on for a while. One of the things we've noticed is that many times the attitudes have to shift before the behaviors catch up. From about the peak of the dot-com bomb to 2008, attitudes had started to shift away from the conspicuous consumption types of things. And then the events of the last 2 years gave it a real big kick in the butt and pushed them over to the behavior side of the equation. And we see this again and again. Yeah, sometimes you have to borrow. But if I want a fixed rate with a known payment schedule for a limited amount of time and an amount that I can be sure. And by the way, one of the things that's always great to do if you're talking about these types of loans, is get out of jail free cards. Something that would enable you to skip a payment one time will overcome a lot of the resistance that people might have otherwise, because you never know when you might need to skip a month because you lost a job or something else happened. It's a nice little thing that you can work into it. To buy anything other than a house or a car on credit is unwise. And if you look at this, and we've got a wonderful trend going back to 1980, it peaked up around there and then went down. And then 2009, it just fell right off the cliff. This is like going back to the 50s. Or if you want, the 1850s, where it was, you know, a mule and 40 acres. The two things that you should borrow for is your mule and 40 acres, a car and a house. And this shows you the retrenchment that I think is going on psychologically in the consumers out there. And will they come out, and will they start spending, and will they go to Neiman Marcus again? Yeah, some. And they'll buy things, yeah, some. But I don't think we're going to see the wholesale conspicuous consumption that we saw prevalent in the 90s and even into the uh-ohs. Okay, credit use down. Purposes are shifting towards pragmatism. Resistance to borrow for a home and car. They're going to borrow less. They want known rates, fixed rates, more important reasons, and strive to save before borrowing. Any way you can facilitate that or help that, you will help yourself to gain relationship and trust, which is something in the next section. This is fascinating. And we're adding some measures in our survey on behavioral economics next time, which are going to be really fascinating, dealing with loss aversion. But this is risk return, okay? How much are you willing to risk to get how much? And it's a 5-point scale, and the low and very low. You saw the people who were only willing to take on low risk went down in the 90s and then went back up and leveled off. So during the 90s, when anybody could throw a dart at the New York Times business section and hit a winning stock, sure, I'm willing to take low risk and get a lower return. No, I'm going to higher risk. Now it's changed. And we go up here to the very high. You can see willing to take high risk just went up, but since 2000, it's been level and lower. And by the way, I've looked at this by households that have lots of money, like $2 million plus in financial assets, mass affluent, middle market. The basic pattern is the same. The one thing that's different as you move up the economic scale, the don't know goes down. But the pattern is the same for the don't know among millionaires as it is for lower income. They went down. Their lack of being able to answer the question of risk return declined. Then it went back up recently. The whole concept of risk has taken on a new meaning. You know, a risk before was not having your money in the stock market because you're missing out on all the great income and asset accumulation value. Now we understand risk isn't quite like that. There's also the risk of being in the market when it goes down, which is much worse. And it goes across most economic strata. So, over the long run, stocks will be a very good investment. The proportion agreeing with that has been declining since 2000. It didn't happen just last night. It happened at the beginning of the O's. And what is the best long-term investment? CDs, savings bonds, and still real estate. And I propose to you, the real estate is because when a consumer thinks about it, it's not so much an investment as a roof that maybe in 20 years I'll be able to take more out of it than I put into it. It's the biggest part of every balance sheet except when you start to get up into the multimillionaire level. I'm willing to take substantial risk to realize substantial gains. The portion agreeing has been going down since 2000. And even the willingness to take some risk to come out ahead of inflation, you know, which the economists will tell you, you have to beat inflation basically to break even. This has been declining since about 2002. So the new environment, attitudinally, and I would say behaviorally in terms of consumers when it comes to taking risk, is not taking risk. It's understanding that they're taking a risk when they're buying a house, but that's probably a worthwhile risk. They're not as willing to take a risk in stocks, mutual funds, ETFs, and whatever. I know you can read, that's why I'm willing to just go through this. The reinforcement that we've experienced in the last 2 years has really been probably a tipping point, thank you, Malcolm, in terms of where we are as a society. I even propose to you that for the millennials and the younger Gen Xs, this is their depression. This is the event that they will be going through, which will change the way they behave for the rest of their lives. And they will end up reflecting this way of looking at life for the next 30 years. Now, the boomers will be impacted for the next 30 years too, but that's because they're going to have to live off of what they got left. I mean, not really invest much of what they have left. They're going to have to figure out a way to do it, which is why I think revolving retirement is going to happen. Revolving retirement is another way to say, I'm working now, but I'm choosing to work. It's a volitional choice. I'm contributing something. I'm making a contribution to society. I'm not using my nest egg up early. Mentoring younger people. It's turning a necessity into a virtue, which the boomers are very good at. So we'll talk about retirement real quickly. Retirement is based on a three-legged stool. You have the money that you have in your retirement accounts. Basically, it had been going up. There were some huge increases, recoveries, if you will. 2010, my guess is that's probably down there. But the second stool, the second leg of the stool, if you will, is the equity in the home. And you can see that because there still are people that don't own homes, the overall mean value went up hugely in 2006 and it already started coming down in 2008. I think we all know where 2010 will be, right? But don't worry, there's the third leg of the stool. We all can rely on Social Security. Any wonder why people are a little nervous when they're starting to approach retirement? I think that's the answer. So we've been looking at this revolving retirement concept, which I explained briefly to you. And what we're seeing here among households over 55 without dependent children is it's starting to creep up here. And my guess is for our next measurement, it's going to be even higher. As more and more people, you know, revolving retirement is another way to say that when you get re-engineered, you're hanging out your shingle and doing your own thing, you're not unemployed. You are freelancing. And when work comes up, you do it. And I think that we're seeing a lot of people who, due to the events of the last 2 years, they are living the dolce vita of retirement revolving. And I don't think that's going to stop, too. I really think that'll just continue to grow. And yeah, for some people at the high Maslowian level, they really are doing it because they've reached a point in their life where they don't need to work as hard and they can do the things that are meaningful to them. I think there's an awful lot of people who will be doing it because they really don't have much of a choice. So I never wanted to play Mahjong for 20 years. We asked people in the after the fall survey we did in the follow-up whether or not their outlook towards retirement had changed. Half of them said, yes, I'm going to retire later than I planned. And then there was about 40% said, I'm going to live simpler in retirement. They've already started scaling back their lifestyle expectations. But then you have over 20% who are saying, retirement, no longer an option. Okay? That's really depressing because we walk around with this idea of retirement in our head like winning the lottery. Now, I propose to you the whole idea will change and that we will get rid of that lottery type of idea. I mean, if you've ever done one of those retirement calculators, don't you ever have to go back and change your expectations and change them to go, oh yeah, okay, I can stay in New Jersey. Retired will stay retired, change career, won't retire, return to work. These down here represent, these two, if you will, the revolving retired concept of people who will continue to work or go back to work or work in a different capacity. So I like to say the three-legged stool goes from a bar stool to a stepping stool. Okay? Gives you a little leg up, but it's nothing that you can reach the ceiling with. They're very different, and I'll just give you 2 or 3 reasons. Father knows best, pensions, and when you have 2 heads that are both making money, and one of them retires and the other one doesn't, if you don't take that into account, the household is called divorced. It doesn't work to say, this day I will be retired. And the point is twofold. Don't look at your customers as individuals. They're households. Even though the products may be owned on an individual basis, they are households. Their needs are based on the household. This person may be retired, but the other person may not be retired. And so in meeting their needs, in marketing to them, in messaging to them, take into account that you're really trying to get to the household's goals and the relationship with the household. Contemplating contingencies and compromises. I guess alliteration is my foil. Revolving retirement time has arrived, and I don't think we're going to see wholesale people migrating to Florida or other parts of the country. So retiring in place, revolving retirement in place, staying in the communities in which they are currently living, because you don't just use financial capital when you retire, you use social capital, you use human capital. And those are your family, your neighbors, your community, and all the other things associated with it. In order to be able to create the type of lifestyle that you can live in, you know, it's not just the money, it's the relationships, it's the things you're doing. And being local banks and being smaller institutions, you're an integral part of facilitating and enabling that. And so think about a revolving retirement in place as a way for you to deepen the relationship with the household. One information and advice. We have this great question that says, what would you like to learn more about? And we asked it before the fall, and people said choosing investments, minimizing taxes, blah, blah, blah. After the fall, this is the proportions that said these things. And if you notice, almost all of them went down except for 2, minimizing taxes and writing a will. Death and taxes. Right? In a situation like what we find ourselves in now, people are focusing back on the types of things that you just can't get away from. That pragmatically, you know you're going to have to deal with taxes. So all these other things are taking something of a back seat. Trust a financial professional a great deal. Before the fall, with the first numbers, after the fall, with the second numbers, and look, big surprise. They're all down. But what's really a surprise is these are not down. The banker, the credit union, and the insurance agent did not take as big a hit in the last fall, because when you think about the plain vanilla types of products and services that you provide, they're dependable. Nobody lost a dime in a checking account or a savings account or a CD. Okay? You know, investing in Goldman Sachs, not so much. Right? The trustworthiness has to do with living up to the expectations. It may have been a curse back when everybody was trying to get into, you know, investments in fancy products, that you're stuck with, you know, the plain vanilla types of products. I don't think it's a curse. I think it's actually a blessing. I know you have to deal with the issue now with the PR and everything else, but consumers do still trust the smaller banks and the smaller institutions that represent their community. In terms of what people would do with a windfall, which is a great insight into thinking where their minds are, the trend here is saving and investing it has basically been down. This is all before the fall, these questions. Paying off debt went up, but is now kind of level. Spending it on the household once went up, but charity slightly down. After the fall, we asked the same question, and this is fascinating. Every one of these items was lower, except the charity. In other words, this windfall question, you know, who actually suddenly stumbles onto $25,000, it represents a sort of a state of mind of what I'm thinking about. And what this means when all three of those are down is I'm not thinking about it as much. It isn't where I'm spending my time. I don't get home and go through the mail and go, wow, another credit card offer. I don't look on my account except to see that it hasn't gone down. I am less involved in my financials than I used to be. Some of that's pain. Some of it also is I have other things to do in my life. And this is a part of it, but it's not going to be all of it. And to us, this is one of the ones we're going to look at very closely to see if these things have picked up again or if they're still at these levels. Because we've been tracking this concept of disengagement for a while. We've seen it during most of the uh-ohs. And we think, in fact, that it's going to continue. That when it comes to financial products and services, they don't care. When it comes to needs that financial products and services are related to, they care. But only when it slaps them in the face. And right now, if they can put it off, they'd rather. Okay, ending interest in learning about topics and declining trust, except it was especially investment areas. The banks and the life insurance agents didn't. Interest in saving, investing, and spending. Disengaged, mistrustful, retrenching, resist and treat skeptically any and all marketing. And I think that's probably pretty obvious to you guys. I'm going to skip through transacting really quick because it basically boils down to the pie is getting bigger, fewer things are being bought with cash, checks are declining, credit cards, debit cards, ATM cards. Actually, credit cards are flat in their percentage. And if you're going to introduce a new type of transaction vehicle, like, I don't know, buying things with your telephone, which is, you know, mobile banking, something else will suffer, even though the pie is getting bigger. So here are old technologies, and you can see they're basically flat. Here are new technologies, and you can see they're up. And here are the two overlaid, which looks like colorful spaghetti that a 3-year-old drew. I think the way to save is to have savings or investments made automatically from my income. Okay? Basically level. I like to keep my financial affairs uncomplicated. Basically level. These two things, I think, are now the dream. I want it to work and I don't have to deal with it. Can you make all of my finances go away? Can you make all my payments automatic? Can you make sure that everything is safe, protected, automatic? I want to be able to check it. I want to be able to have a get out of jail free card in case I have to make an alteration. And whereas that was something that in the 80s and 90s was very difficult, it's not that hard anymore. The technology exists to do it. But from the consumer's point of view, it's got to be simple. It's got to be easy. It's got to make sense. Set it up once and then leave it. So transacting real quick, I'll go to the end, which is the next slide, and talk about the other thing. Okay? Overall, life stages are multiplying. And the more you understand consumers and the life stages and how their needs relate to the life stages, then you know how to put the products to meet the needs for the life stage. Another thing that's very useful are life events, so that you know what are the triggers for the changes in life stages or the changes in need, which then you sell products to. Conspicuous consumption to conspicuous conservation. I want credit for that phrase. Basically, make it easy, make it make sense. Think Prius, not Cadillac, when you're putting together bundled services for a life stage. Combining needs across generations. Savings account for the boomerang kid that automatically takes some money from the parents and puts it in there on a monthly basis. And eventually they save enough for a down payment to get a car, get a job, get out of the house. This disengagement is the headwind that you're all facing out there. People are more skeptical. More is less, and less is more. Very Orwellian. And this revolving retirement is here for now and going to continue. So these are the backgrounds of what we see looking at our data, analyzing it for a lot of the big banks, brokers, mutual funds, insurance companies, several government agencies, 2 universities, and a handful of associations. This is what we do for a living. But I got to tell you, there are a lot fewer financial institutions that can afford the $110,000 it costs to buy our program. None of you can afford it probably, and I'm not asking you for it. But we're going to try an experiment here in New Jersey because I'm from New Jersey, and if the world ended, I would adjust. What I'd like to do is offer to you and your colleagues the opportunity to call us whenever you have a question or an issue that you think we might be able to shed some light on. We will then tell you how we can shed light on that issue, and we'll tell you what we will charge you for that shedding. And then you agree to it or don't agree to it, and we'll see if it works for a year and do these things for you on an ad hoc basis. I have to find a model that works so that I can continue to do the $2 million data collection effort I do every 2 years that helps me understand how consumers are shifting. I can't begin to tell you that this data set, and I think you may have gotten a sense from listening to this, I really have a great idea of where consumers are heading. I really think I understand what's going on because these trends didn't just happen last 2 years. There are trends that have been going on for the last decade. And integrating it all is something I'm uniquely positioned to do because nobody gathers. I didn't tell you, our questionnaire is 96 pages long. We get 44% of the people we send it to filling it out. We get a remarkable response rate because among the things we give them to do it isn't a lot of money. It's basically $10. But we give them a custom analysis comparing themselves and how they're doing to people in their age range, life stage, and income range. So they can tell, like Ed Koch used to say, how am I doing? They can tell how they're doing from somebody that's not trying to sell them anything and who really does it with real means and medians, so it's not like you need 6 times your annual income in life insurance. You know, if I'm a life insurance agent and I'm telling you that, not so much. So what we want to try to do, and only for New Jersey, and only for you guys, is to offer this opportunity to you. And I'm going to be sticking around. I'll be happy to talk to you about this. I love talking about this stuff. I love getting feedback in terms of things you've experienced, you're seeing in your communities, you're seeing in your customers. This all goes into helping us to understand this better. And a couple of questions. Are there any questions out there that I can maybe relate some of this to? We have lots of variables in our 96-page long questionnaire. And if we don't have it, I'll be amazed at anything that you'd want to bring up. Great. Thank you all very much for your attention.
We hope you enjoyed this presentation from the New Jersey Bank Marketing Association. For more information, visit njbankmarketing.com. We produce these programs in the studios of Professional Podcasts in Cherry Hill, New Jersey. On the web at professionalpodcasts.com. This is Steve Lubetkin. Thank you for joining us, and we'll see you out there on the net. Take good care.